I looked over the 2023 outlook for 19 of the top investment banks in the world so that you don't have to. All of them said 5 key things. And if you are looking to invest in 2023, trust me, you're going to want to hear this. Every single year, the big asset managers, investment banks, and wealth managers like BlackRock, Goldman Sachs, JP Morgan, Morgan Stanley, all release their annual outlook for the year to come. These guys are the best investors in the world. And even more importantly, many of them are the market makers. So what they think really matters because it will influence how markets behave. And every single year, they literally tell us, guys, this is what we think about how markets are going to behave. But we as ordinary investors don't pay attention to that because they hide that analysis behind the camouflage of lots of boring graphs. And make sure you stick around until the end because then I'll share with you how these 5 take-homes actually influenced my own investment strategy for 2023. Now, the first thing the bank said was we all need to pay attention to the temperature of the economy around us. Now, when we take a temperature, we use a thermometer. But when banks take the temperature, they look at inflation rates and interest rates. Now, you see, central banks can basically only do one thing. They have a car that only has one button, and that is interest rate up or interest rate down. And through that single dial, they need to control everything. Now, when they put the interest rate up, it does control inflation, which is great. But the problem is it also chokes off growth in the wider economy, which is bad. Now think of it this way, you've got a big room with a big ice block in the middle of it. Because of that ice block, the room is getting cold. So you put in a heater and you start warming the room up. Great. So the temperature of the room is going up. However, there's a problem because when you put the temperature up, the ice starts to melt and then you have lots of water that you have to mop up. So the balancing act that a central bank does is it turns up that temperature by just that right amount that keeps it hot enough for us all to survive, but not too hot that there's going to be an epic flood that you can't deal with through the ice melting. So the big question is, can the central banks keep the room, the economy warm enough whilst keeping inflation, i.e. the melting ice, under control? Most banks think this can be done. They think that the USA is largely going to avoid a full-on recession, but it is going to be damper. And in the EU, there is going to be probably a recession, but hopefully it's going to be a mild one. Let's get into where the profits are going to be made. Now, all of the banks noted that the stock market has come down very significantly, and so there are now bargains to be picked up left, right, and center, in particular in the defensive sectors, not to be confused with the defense sector, also anything that's climate-related technology, and finally, the emerging market space as well. However, BlackRock in particular said that they expect there to be a further correction in the stock market over the coming 3 to 6 months. And after that, they expect that they will then become a lot more aggressive in buying up stocks because they have become a lot cheaper. Tech stocks, ladies and gentlemen, will remain in the dumps. And this is not going to be the age, the era of passive investing and dollar cost averaging, at least in the short term. However, it will be the era of macro investing, of volatility investing, and looking for things that are value-based investments as well, i.e. things that are cheap and that you get a chance to sell them for much pricier later on.
What Ibrahim is trying to say is that this is the age where you invest in an asset that is sensibly priced. From a sector that is growing nicely, such as chemicals, utilities, or energy, in the hopes that when the stock market goes up, you make a good profit.
You can figure out a reasonably priced stock by looking at the price to earnings ratio, the PE ratio. Typically, anything that has a PE ratio of north of 20 is usually considered to be a little bit on the pricier end of the spectrum. For context here, guys, Tesla at a certain point over the last year and a half was actually trading at 190 times its earnings, its revenue. That's pretty bonkers. And now obviously it's come down significantly.
This is opposed to dollar cost averaging / passive investing, which is basically when you invest regular sums of money at regular intervals, regardless of the asset's price, hoping that it steadily goes up. Which what Ibrahim is saying, in the current state of the economy, if you're planning to invest in the next 1 to 3 years, is probably not a good idea. If you're investing for 10 plus years, then this is probably still fine as a strategy. Also, please make sure you like and subscribe to our channel. Otherwise, Ibrahim makes me do stuff like this.
Thank you, Khizr. Now, the next point is all about jumping on the trend lines. For all of you TikTokers out there, here's a top tip. You know that silly video we just saw of Khizr sat in his shower? Well, actually, that silly video ended up ranking as our most popular video on TikTok and brought us a ton of subscribers and followers as a result. And you know why? Well, it's because we jumped onto a trend that this video was part of people for some reason sat in showers crying. You see, high quality investments are nice, but when you have really strong tailwinds behind you pushing you along, that's when you are really going to get the good returns, because it's not just the quality of the investment, it's just this entire tidal wave behind it that carries it to a peak that you could never otherwise reach yourself. Now, according to these reports, if you are looking for this growth, this tidal wave, you need to look outside of the West. You need to look at places like China, India, the Middle East, Southeast Asia, and possibly even Africa as well. The growth story here is underpinned by some key factors, such as the post-COVID recovery,
meaning how quickly they handled the COVID pandemic and got their economy on track.
A manufacturing renaissance,
meaning how well their manufacturing industry is doing in terms of exports. Remember, more exports from a country means more money coming into the country.
Commodity tailwinds,
meaning all the money that countries can make from mining and refining various commodities such as gold, steel, lithium, and nickel.
Digitization,
meaning how well a country has adapted digitally. For example, how much of the population have smartphones? Does the country have good telecoms infrastructure? And how many businesses are accessible online?
And a favorable political cycle,
meaning that they're politically stable with good law and order.
Thank you, Khizr. Now, most people are underweight on emerging markets, i.e. their investments are not exposed that much to emerging markets. However, these big investment banks are saying specifically that their focus and their clients' money will increasingly be diverted and focused a lot more on emerging markets when it comes to growth. Point 4 is now getting into the really good stuff. We're talking about private markets.
Private market investing is investing in companies that aren't on any public listed exchanges. Basically, the public can't invest in these. You have to go through private channels to invest in these companies. A good example of them are startups.
Smashed it, Khizr. Anyway, according to these reports, that weary investors who have had their portfolios of 60-40 stocks versus bonds absolutely hammered over the course of 2022 are now coming up for air thinking, hang on, we need to recalibrate our portfolios, and are increasingly going to be looking at private markets for options and safe havens.
Public equities are whatever is exchanged on public markets, such as public stocks or cryptos.
Purchase price really matters when it comes to private markets, and according to these reports, there are going to be bargains on offer and available during the course of 2023, in particular in the real estate sector, the private equity sector, and the private credit sector as well.
Private credit is when anyone other than a bank is providing financing for a company. So that could be investors, for example.
The fifth and final theme that was common across all of these reports was the emphasis on fixed income. Significant fixed returns are now on offer throughout the international bond markets, the kind of returns that were never heard of for the last decade or two. This will likely be an attractive place for risk-adjusted returns for investors to park their money into over the next decade, particularly because bond markets tend to do better when stock markets are in the doldrums as they are right now. For Muslims, of course, the Islamic equivalent of bonds are called sukuk, And we've done a separate video going through all of this in a lot of detail here. So to summarize, keep an eye on the temperature, aka the interest rate and the inflation rate. Number 2, buy stock market bargains. Number 3, follow the smart money. Number 4, look at private markets and readjust your portfolio if it's not got any private markets in there. And number 5, look at how you can earn while you sleep. Whew, that's a lot of information, but how is that going to influence my investment portfolio and your investment portfolio? That's what matters. As this video isn't financial advice, what I'm going to do is I'm going to share with you how I am thinking about my own investment portfolio and game plan for 2023. And you can hopefully draw some ideas and inspiration from that. But if you do need to, make sure that you do your own research and then talk to a financial advisor to get detailed analysis to the extent needed. So folks, I'm going to be making 3 key adjustments to my portfolio. Number 1, I'm going to shift my existing stocks portfolio into a lot more emerging markets and defensive stocks. So before Khizr interrupts me, what that means is I'm going to invest a lot more in the mining sector, in biotech, in utilities, manufacturing, in electrical manufacture, in medtech, semiconductors, and also business and administration services, as well as HR services as well. I'll also be exploring how I can gain exposure to emerging market stock indexes. So for example, I recently found out that there is a Palestine stock exchange. I had no idea. Did you? I also personally am really interested in stock market trading, and so I'll be experimenting with and learning a little bit more about swing trading. Now, swing trading is not for everyone, and it is a higher risk and more volatile way of investing, and it requires a significant commitment of time and capital. And if you do make mistakes, you're going to end up losing money.
Swing trading, simply put, is when someone invests in stocks for the short term and holds them for between a few days to a few weeks even, and tries to profit when the price swings upwards, at which point they quickly sell the stock and repeat the cycle.
You beat me to it, Khizr. Right, so the second thing I will be doing with my portfolio in 2023 is I will be building up my private markets investments, particularly in private fixed income, in real estate, and if I can get it, private equity as well. As the report said, there's a lot of opportunities that are going to be available in this sector, and I'm going to keep my eyes peeled. I'm actually going to look to make most of my private investments through Qurate Capital, which is the investment arm for IFG. And the reason why I'm doing that is, and by the way, I will be keeping my eye open for things that I can do independently as well. But the thing is, when you are clubbing together with lots of other investors, you have a lot more capital behind you, millions of pounds worth. And so that means that you get into better conversations with investors and with potential opportunities than you would ever do independently. So that's why I'm probably going to do most of my investments through Qurate Capital. And finally, my third big adjustment to the portfolio will be I'll focus my venture capital investments much more towards emerging markets and climate related technologies, because that's where I think there is a huge amount of growth, and technology will have a huge bearing on that in the next coming decades. Look folks, I know that was pretty brief, particularly when I went through my own investment strategy. So I'll be doing a detailed video breaking that down for you further in the coming days. So watch out for that. And look folks, we obviously don't charge you for making these videos, and this stuff, as you can see though, does take a lot of time and effort and energy and people. So if you would like to support this work, then please do subscribe to the channel. Most people actually watch videos, don't subscribe to channels, but subscription is what keeps this thing growing. So please do that. Until next time, Assalamu alaikum.